Hello and welcome to this webcast on IFRS 16. I'm Patrina Buchanan and I'm joined today by my colleague Catherine Dunkersley. This is the fifth in a series of webcasts following the publication of the new Leases standard, and today we'll be talking about the measurement requirements for lessees in IFRS 16. Now, just to note before we start that, as always, the views presented in this webcast are those of myself and Catherine and don't necessarily represent the views of the board or the IFRS Foundation. So today we're going to be talking about measurement, and specifically how a lessee measures the lease liabilities and right-of-use assets that it recognises on its balance sheet in accordance with IFRS 16. For the avoidance of doubt, we're talking about the general requirements of IFRS 16 and not the transition requirements on initial application of the standard. Those were discussed in a previous webcast in the series. Now, lessee measurement is a big topic and it's one of the most detailed areas of IFRS 16. So what we will do in this webcast is concentrate on those elements of measuring lease assets and liabilities that involve judgment, or where we're aware of implementation discussions since IFRS 16 was issued. So just to note that we'll mostly be talking about initial measurement of lease assets and liabilities, and that means we won't be talking in detail about subsequent measurement, and we also won't be discussing the requirements in IFRS 16 relating to lease modifications. But in terms of what we will be covering, we'll start today by talking about the lease liability and look at a number of particular elements of that. Lease term and the reasonably certain assessment, variable lease payments, in substance fixed lease payments, and the discount rate. We'll then talk about measurement of the right-of-use asset. So let's start then with measurement of the lease liability. Now, at this point, a lessee will have already decided that a contract contains a lease and will have separated out any payments for services. And we discussed these areas during the April webcast on the definition of a lease. The next step is then to measure the lease liability. And essentially, the lease liability at the start of a lease is measured at the present value of the lease payments that will be made during the lease term. That means measuring the lease liability is effectively a three-step process. First, a lessee needs to determine the lease term. Then it needs to identify the lease payments that will be made during that term. And finally, it needs to apply an appropriate discount rate to those lease payments to arrive at the lease liability. Now, for a simple lease without any complicated contract terms, this measurement is likely to be a straightforward process. However, each of these three steps could involve elements of judgment if, for example, there are any complicated contractual terms to consider. You can see the different things that you could factor into the measurement of the lease liability on the slide now. And this looks like a long list. However, most of these things relate to particular contractual terms, and each of them will only be relevant when those particular contract terms arise. So the first area that we'll talk about relates to determining the lease term. Specifically, we'll be discussing what a lessee should be doing with extension and termination options. So, for example, we'll look at the factors that a lessee should consider when thinking about whether to include a period covered by an extension or termination option within the lease term. Second, we'll look at a couple of particular elements of identifying lease payments. We'll start with variable lease payments, again looking at when these should be included within lease payments and when they shouldn't. And we'll also talk about the concept of in-substance fixed lease payments. Finally, then we'll talk about discount rate. In particular, looking at how a lessee arrives at the appropriate discount rate to apply in measuring the lease liability. So starting then with extension and termination options in the lease. Catherine, could you talk about how these affect the lease term?
Yes, of course. So essentially, this is similar to IAS 17, in that what a lessee needs to do with an extension or a termination option is to assess whether it is reasonably certain to exercise that option. If a lessee is reasonably certain to exercise an extension option, then the period covered by the extension option should be included within the lease term. Similarly, if a lessee is reasonably certain not to exercise a termination option, then the period that falls between the termination option and the contractual end of the lease should be included within the lease term. That's the same as the requirements in IAS 17 today for determining lease term.
So on that basis, can entities just carry on doing what they were doing before when looking at extension and termination options? So is reasonably certain exactly the same concept as it was in IAS 17?
Good question, and probably the first thing to say is that the board purposefully kept the same language as IAS 17 here, because the concept of reasonably certain is the same applying the new standard as it was before. However, it's very important to note that, similar to something we talked about on the definition of a lease, the assessment of reasonably certain is a lot more critical applying IFRS 16 than it was previously. That's because before, concluding that, say, an extension option was reasonably certain to be exercised meant that for operating leases, the payments associated with that option would be disclosed in the operating lease commitment note. Applying IFRS 16, reaching that same conclusion means that the lease payments will be included on the balance sheet. So whilst the reasonably certain concept is the same, it matters a lot more, and in practical terms, the judgment around reasonably certain may be applied with a bit more rigour. For that reason, it's worth talking in a bit more detail about that judgment, and in particular, the kinds of things that lessees should have in mind when making it. So this slide shows some of the things that lessees should be thinking about when making the reasonably certain assessment. IFRS 16 requires a lessee to consider all relevant facts and circumstances that create an economic incentive for the lessee to take the longer lease term. On the right-hand side of the slide, you can see some examples of circumstances that might create such an economic incentive. Some of these are fairly straightforward, and if these circumstances exist, then it's likely that the lessee will be reasonably certain to take a longer lease term. So, for example, if the lease has favourable terms compared to market, say lower than market rents during the optional period, then that would create an economic incentive for a lessee to want to extend the lease. Another example is that if a lessee had done some significant leasehold improvements, say fitting out a leased property, it might be that these improvements mean the lessee has an economic incentive to extend the lease. This might be the case if moving to another property would require another economic outflow in doing similar leasehold improvements, or if exiting the current lease would mean the lessee didn't utilise the full economic life of the existing leasehold improvements. Other circumstances that might create an economic incentive for a lessee to exercise an extension option or not to exercise a termination option might be if there is a direct cost of doing so, such as a termination penalty or substantial relocation costs. Another example might be if the leased asset is very specialised, such that a lessee cannot easily source an alternative. In this case, if the asset is essential to the lessee's business, it would have an economic incentive to retain the lease for as long as possible. Now, in any of those circumstances, it's likely that the lessee will have a clear economic incentive to extend, and therefore be reasonably certain that it will take an option to extend. This judgment won't always be straightforward though. Companies need to consider all elements of a lease contract when making the reasonably certain assessment, and there are other factors that might be relevant. Some examples are on the slide now. First, interaction with other contractual terms. It might be that when an extension option is considered in isolation, a lessee can't conclude that it's reasonably certain to extend. However, When considered within the context of other related contractual terms, the conclusion might be different. Take, for example, a contract in which a lessee enters a lease with a 3-year committed lease term. At the end of that 3 years, the lessee has the choice to either extend the lease for a further 3 years or to purchase the asset. It has to pick one of those two options. In this case, considering either the extension option or the purchase option in isolation might lead to the conclusion that neither is reasonably certain, because the lessee might choose the alternative option and reasonably certain is a high threshold. However, if, as in this example, the lessee must choose one of two options, then it is prohibited from excluding both options from the measurement of its lease liability. In other words, the lessee in this example must either measure the lease term including the period after the extension option or include the exercise price of the purchase option within the lease payments. Another example of something that will need to be taken into account in making the reasonably certain assessment is past practice. IFRS 16 requires a lessee to think about its past practice as to the period over which it has typically used particular types of assets. For example, imagine a lessee that leases lots of a particular type of equipment, say delivery vans, that are obtained by way of 2-year leases with an extension option covering a further 2 years. If the lessee historically tends to always use each van for 4 years, then, in the absence of any new economic factors or significant changes to the lessee's business, past practice would suggest that it is reasonably certain to exercise the extension options. The last example I'll mention is the length of the non-cancellable period. This might also be a factor that an entity needs to think about when making the reasonably certain assessment. IFRS 16 notes that the shorter the non-cancellable period in a lease containing options, the more likely the lessee is to extend the lease term. That's because the costs of negotiating a new lease or otherwise obtaining an alternative asset will be proportionately higher the shorter the period for which an asset is leased.
Thanks, Catherine. Now, the next area we'll talk about is variable lease payments. And in particular, when should they be included within lease payments? And when they are included, how should they be measured? So first, which variable lease payments should be included within the measurement of lease payments? So essentially, they should be included when the payments depend on an index or a rate. And so this would include, for example, payments that are linked to CPI, benchmark interest rates such as LIBOR, or payments that vary to reflect market rental rates. Other variable lease payments are excluded, provided that they contain genuine variability. Now, that's something we'll talk about in more detail in the next slide. So given that the variable payments included within lease payments will be varying based on some kind of index or rate, the next question is, of course, how to measure them. This question applies both to the initial measurement at the start of the lease and also to what should be done subsequently as the index or rate changes. So we'll start with initial measurement. At the beginning of a lease, any variable payment should be measured based on the value of the index or rate at the commencement date. So that's the date that the underlying asset is made available to the lessee. So to take an example, imagine a lessee enters into a 10-year lease with annual lease payments of 100 that will increase every 2 years on the basis of the increase in a particular rate. At the beginning of the lease payments used for measuring the lease liability are taken to be 100 in each year throughout the 10-year lease term. Now, after initially measuring the liability, a lessee is required to remeasure the lease liability when there is a change in the cash flows relating to lease payments linked to an index or a rate. So if I take the example that I mentioned before, then there is a change in cash flows after 2 years when the reference rate changes. And at that point, The lessee remeasures the lease liability, assuming that payments throughout the remaining 8 years of the lease term will be the same as they are when changed at the end of year 2. So if 2 years after lease commencement, the particular rate is increased such that the lessee now pays 105 annually, the lessee remeasures the lease liability, assuming annual lease payments of 105 throughout the remaining 8-year lease term. Now we'll talk about discount rate a bit later, but for completeness, just to note that the discount rate is typically not reassessed in this situation. The lessee typically continues to use the same discount rate that it applied at commencement of the lease. Now, everything I've just talked about relates to those variable lease payments that depend on an index or a rate. The next topic we'll talk about, which is in-substance fixed payments, really relates to another type of variable lease payments, by which I mean those variable payments that are linked to something like sales or usage of the underlying asset. An example of this would be a property lease for a retail store in which some lease payments are a percentage of sales made from the store. Another example would be a lease of a vehicle with payments linked to mileage. Now here, IFRS 16 tells you that these types of variable payments do not need to be included in the measurement of the lease liability. Instead, they are recognised in P&L as they are incurred. Having said that, however, this won't always be the case. And that's where the concept of in-substance fixed payments comes in. So Catherine, can you tell us about that?
Sure. So as you said, the general rule with sales or usage-based variable lease payments is that they will be recognised in P&L as they are incurred. However, that will only be the case if the payments contain genuine variability. And this is where the concept of in-substance fixed payments comes in. In short, IFRS 16 identifies that some payments can be labelled as variable in a contract, but in reality, the lessee has no way of avoiding making those payments. In other words, this is a substance over form issue. Essentially, all lease payments that are in substance unavoidable by the lessee need to be included in the measurement of the lease liability, whether or not the contract uses the word variable. This concept is something that we've heard some discussion about as IFRS 16 is being implemented. So let's look at a couple of examples. Consider the example of a retail store with some sales-linked variable payments. Say, variable lease payments are 5% of sales made out of the store. As with all contracts, it's important to understand the underlying economics. And a good way to do that in this case is to think about how the lessor is covering their risk. Here, for example, if there are no other fixed lease payments in the contract, the lessor is effectively giving away use of the property for 5 years and is potentially at risk of getting a zero return. It's likely that they will be covering that risk somehow in the contract terms. One way this might be done is through a minimum rent clause. So, lease payments are 5% of sales, but if sales are less than 100, then a lessee still has to pay a minimum rent of 5. In this case, the minimum rent of 5 is a payment that the lessee cannot avoid in any circumstances. Therefore, this is what IFRS 16 would define as an in-substance fixed payment, and that 5 must be included in the measurement of the lease liability. It is only any payments above that 5 that would be genuinely variable and recognised in P&L as they are incurred. Another alternative is that it might be the case that to compensate for the risk of a zero return, the amount of the variable payments is increased. Say the contract might include rentals of 7% of sales rather than 5%. In this case, the lessor might be prepared to take the risk of no payments for the upside of the potentially higher return. Thinking about it from the lessee's point of view, Accepting these terms indicates that the flexibility offered is something that they need and that they're prepared to pay for. Putting all of this together, it is in substance really the case that this contract offers genuine variability, and therefore these variable payments would not be included within lease payments, but instead recognised in P&L when they occur. In summary then, payments that contain genuine variability that a lessee is prepared to pay for are not included in the measurement of the lease liability. On the other hand, payments which the lessee cannot avoid making must be included in the lease liability. That might be by way of a minimum payment term, as we've discussed here, or it might be similar to the scenario we looked at on slide 5, when a lessee has a set of options, but each of those options result in a payment being made. In these cases, because there is no genuine variability, something needs to be recognised on the balance sheet. So in short, if it is impossible for the lessee to avoid making a payment, then that payment needs to be included in the measurement of the lease liability.
So let's move on then to talk about discount rate. And this is the final input into the initial measurement of a lease liability. So having determined the lease term and identified the lease payments during that term, a lessee then applies an appropriate discount rate to arrive at the lease liability. Now there are two discount rates that may be relevant applying IFRS 16. The first of these is the rate implicit in the lease. This is effectively the rate that the lessor has used to price the contract, and that's defined in the same way as it is in IAS 17 today. So in a simple case, say a lease would be a finance lease today with no expected residual value, then it would be the rate that, if used to discount all of the lease payments over the lease term, would arrive back at the fair value of the asset provided to the lessee at the start of the lease. However, in pricing the contract, a lessor will generally factor in the residual value of the asset that it expects to get back at the end of the lease term, as well as any initial direct costs that it incurs. So if they are relevant, then these also need to be taken into account in arriving at the rate implicit in the lease. Now, if a lessee can readily determine the rate implicit in the lease, then this is the rate that should be used as the discount rate for initial measurement of the lease liability. And it's generally going to be clear whether or not the rate implicit in the lease can be readily determined. Essentially, the lessee will either have the information to determine it, or it won't. A lessee will always know what lease payments it is agreed to make, but it may not know the value that the lessor has assigned to the residual value in pricing the contract, or whether the lessor has any initial direct costs. So if a lessee doesn't have this information, then the rate implicit in the lease is unlikely to be readily determinable. So in many cases, a lessee will need to look at the incremental borrowing rate. Now this is the rate that a lessee must use in the event that it cannot readily determine the rate implicit in the lease. Now this is something that we've had a couple of questions on. Really those questions are practically, what does this mean? So we'll try to address some of those now. Now on the screen you can see the definition of a lessee's incremental borrowing rate as it is defined in IFRS 16. And there are a couple of key things to point out here. Now the first is that the incremental borrowing rate is defined at a contract level or individual lease level. So it's not the case that a company will have one incremental borrowing rate that can be used for all of its leases. Instead, in arriving at the incremental borrowing rate to be applied to a lease, a company must consider factors such as the length of the lease, the quality of any collateral, the economic environment, and so on. Essentially, the rate to be used is that which an entity would have to pay for borrowings with similar characteristics to the lease.
So to clarify, Petrina, what does that mean in practical terms? A different incremental borrowing rate for every lease?
Well, no, that's very unlikely from a practical perspective. So the most realistic practical outcome here is that a lessee will use the same incremental borrowing rate for groups of leases with similar characteristics. Now, we understand that it's common for companies to have multiple similar leases. So, for example, if a company leases lots of a particular piece of equipment in the same territory over the same period, then all of those leases might have similar contractual terms. And in that case, an entity will be able to apply the same incremental borrowing rate to all of those similar leases. And it may well be that there will be several such groups of similar leases and therefore several different incremental borrowing rates used across a company. Now, the more significant an individual lease, the more likely it is that the lease has unique characteristics, and thus the more likely it is that the discount rate will need to be determined for the individual lease. So we've had a few questions about whether it is always possible to work out the incremental borrowing rate, which I'll try to address. First, the board was pretty clear that their aim with the discount rate is to reflect how the lessor priced the contract. But there are certain leases that exist, say some shorter-term property leases, for which the exact rate used to price the contract may not be clear. Second, we've also heard about situations where lessees might think that they have no basis on which to assess the rate that they could obtain to borrow on a similar basis to the lease. So one example that's been raised is a 20-year lease of an asset. So what if a lessee doesn't have a 20-year borrowing or couldn't take out a loan for 20 years? Then how does it work out the incremental borrowing rate? So a couple of things a lessee might think about in this situation. So first, it might be helpful for a lessee to really think about the basis on which it negotiated the 20-year lease. So to try and explain that, to be in this position of having the 20-year lease, a lessee must have been prepared to commit to particular lease payments over the next 20 years. And it would have done quite a bit of analysis on the pricing of that 20-year lease in order to agree to the terms. So put another way, the lessee would have assessed whether the pricing of that 20-year lease is the most effective form of financing for its business. So the lessee is likely to have some information available from that assessment of whether to enter into the lease that can be used to help determine the incremental borrowing rate. Another thing a lessee might think about is what alternative sources of information might be the most relevant information available. So, for example, are there any relevant property yields available when considering a property lease? Another possibility might be, for example, could the lessee identify how its credit risk fits into accepted rating scales and apply something like a bond rate for a similar term to the lease? Now, ultimately, a practical approach might be to identify a rate that is observable as a starting point and adjust that rate as necessary to reflect the terms and conditions of the contract. And I think it's also worth noting that it may be helpful to involve people within the company that were involved in the lease negotiations when determining the incremental borrowing rate. Now, that covers everything we've been talking about on the lease liability. Now we'll talk a little about the right of use assets.
So this section on measuring the right of use asset will be a lot shorter. And that's because the starting point for measuring the right of use asset is the value of the lease liability. So by measuring the lease liability, most of the work here is done. It's just worth mentioning, though, the few things that may give rise to a difference between the lease liability and the right of use assets at the commencement of the lease. These are listed on the slide now. So first, any upfront lease payments. These won't be in the lease liability, as they've already been paid, but they do form part of the cost of the right of use asset, so need to be included in the measurement of the right of use asset. Second, we've got lease incentives received from the lessor. These effectively constitute a discount on the cost of the right of use asset and therefore reduce that cost. Third, initial direct costs. These are incremental costs that are incurred only because the lease was obtained. So an example would be if a lessee had to pay an amount to a previous tenant to vacate a property that it now leases. These costs are included in the cost of the right-of-use asset so that they are depreciated over the life of the lease rather than being recognised as an expense. Finally, the last item on the slide is dismantling and restoration costs. This might relate to a scenario in which a lessee, say, makes some changes to a leased asset and knows that it will be obliged to incur some cost to return the asset to its original state at the end of the lease. In that case, it's again appropriate that those costs will be depreciated over the life of the lease. Therefore, where such an obligation exists, those costs are also added to the right-of-use asset. It's also important here to note that, similarly to IAS 16 accounting for property, plant and equipment, the inclusion of these restoration costs within the cost of the right-of-use asset is dictated by the accounting for the corresponding restoration obligation applying IAS 37.
So we've now talked through the more judgmental elements of measuring lease liabilities and right-of-use assets. This final slide notes a couple of links to further information that can be found on our website. The second link, which is to the Leases implementation page, summarises all of the work the board is doing to support implementation. And within that, there's some information about the rest of this webcast series, links to previous webcasts, and the list of upcoming webcasts can be found by following this link. We thank you for listening to our webcast today and hope that it was helpful.